Every week, I see headlines saying convert to Roth now or pay massive taxes later. But when you actually look at the numbers and the research, here's what the data shows. Roth conversions are a beneficial strategy for a select few percentage of retirees, which means 98% of people are being given this information that doesn't apply to their situation. I'm Wolfe, certified financial planner and IRS enrolled agent. In this video, you're going to learn what the research actually shows about Roth conversions, why the widespread advice doesn't apply to most retirees, and the systematic 3-tier wealth analysis that reveals who should actually consider Roth conversions and who should focus on other strategies. Before we go any further, it's important to note here that this information is strictly educational and should not be considered as investment, legal, or tax advice. Before we get into why it doesn't necessarily make sense for most individuals, I want to show you exactly how this conversion advice became so widespread and why it's creating problems for most individuals. There is a fear spreading in retirement circles that if you don't act now, taxes will explode in retirement and you'll be left holding the bag. This fear is driving retirees into Roth conversions at an unprecedented pace. But here's what's actually happening behind the scenes. The issue isn't with Roth conversions as a financial tool itself. They can be valuable in specific situations. The problem is how they're being presented as a universal catch-all solution when they actually only benefit a very small percentage of retirees. And once you see who actually falls into that small percentage, everything will start to make more sense. I categorize retirees into 3 wealth tiers based on total assets, and the conversion strategy is completely different for each tier to consider. So let's start. Tier number 1, under $500,000 in assets. For this group, the vast majority of Americans, Roth conversions are rarely going to provide a meaningful benefit. If you're in this group and someone's pushing conversions, here's what you need to know. The exception is a small subset with unusually high guaranteed income sources like Social Security benefits combined with one or multiple pensions. The simple test here, do you expect your guaranteed income in retirement to exceed your pre-retirement income? If yes, then model a Roth conversion to see if this makes sense. If no, conversions will likely be a net negative over your retirement lifespan. This simple test eliminates conversion consideration for approximately 90% of the people in this wealth tier. That's 90% of people right there who can stop worrying about conversions. Tier number 2, $500,000 to $5 million. The tier requires careful analysis, and this is where most problematic advice is being targeted. You may benefit from conversions, but only under very specific conditions. And I mean very specific. Condition number 1, you have a gap retirement period. Time after you stop working, but before Social Security or pensions begin, and you can live comfortably on after-tax money, non-retirement, during this period without reducing your quality of life. That's a big ask and a hard needle to thread. Condition number 2, you can pay conversion taxes using after-tax money, keeping your pre-tax distribution and tax brackets lower. Most people can't do this and will need some level of retirement funds to pay for the tax on the conversion in the year that they move the funds. Condition number 3, you're preparing for specific future tax disadvantages, like the widower tax penalties when filing status changes from married filing joint to married filing single, or significant Medicare IRMA surcharge increases after required minimum distributions begin. This is planning for scenarios most people prefer not to think about. Only when most of these conditions align does a Roth conversion in this wealth segment make more financial sense. Tier number 3, over $5 million. Here's where conversions actually start to make more sense. Conversions are typically advantageous here for both personal tax savings and estate planning benefits. These retirees are likely already in the highest tax brackets due to investment income from their asset base. They have a completely different problem than most retirees. They also face large required distributions and can afford to pay conversion taxes in most cases while absorbing higher withdrawal rates to benefit their heirs. Money isn't the constraint here. Taxes are. So the reality check. When you analyze all three tiers, only about 2% or so of retirees actually meet the conditions where conversions provide meaningful long-term benefit over their lifetime. Think about that. You're getting advice meant for 2 out of every 100 people. Now, if this wealth tier analysis is helping you see where you actually stand with Roth conversions, do me a favor and hit that like button. It helps me reach more people who need this systematic approach. And I'm curious, which wealth tier do you fall into? Now let me show you exactly why the fear-based advice is built on shaky ground. Let's examine the foundation of most conversion advice. The assumption that taxes will significantly decrease. This is where the fear-mongering really falls apart. What the data shows, according to the Pew Research Center polling, is that 56% of Americans feel they already pay more than their fair share of taxes. While the public supports higher taxes on corporations and wealthy individuals, they oppose tax increases on themselves. We are just past the Tax Cuts and Jobs Act extension, where this legislation made those deductions and lower tax rate environment permanent, removing the scenario of automatically expiring lower tax rates. And the fear you're hearing is based on outdated information and incomplete at that. The political path of extending tax cuts while expanding deficit has become more of an established policy. Now, what this means, if tax rates do increase in the future, they're likely to be marginal increases targeted at the highest earners. For most retirees who aren't at those top marginal brackets, the likelihood of facing these steep personal tax increases is low. The fear is largely manufactured. But even if you avoid the fear-based advice, here are 6 costly mistakes that can destroy any potential conversion benefits. Mistake number 1, incomplete tax analysis. This is the most common mistake I see as an IRS enrolled agent. Making conversion decisions without understanding your complete tax picture, including all income sources like dividends, interest, and other investments. This could mean, if we are doing a conversion, that we're also making our retirement income from non-retirement accounts taxable, when otherwise it may not have been. Mistake number 2, short-term tax focus. Optimizing for this year's tax bill instead of analyzing their lifetime tax burden across their entire retirement. We're being penny-wise and pound-foolish. Mistake number 3, ignoring tax interactions. This is huge and most people miss it. Conversions can trigger taxes on your Social Security benefits, increase capital gains rates from 0 to 15%, cause Medicare income-related monthly adjustment amount surcharges, or eliminate massive Affordable Care Act health insurance subsidies. These interactions often eliminate conversion benefits and need to be done on a very specific year-end tax projection on a year-by-year basis. These interactions often wipe out many of the benefits completely. Mistake number 4, the early distribution penalty. If you are under 59.5 and withhold taxes from the conversion amount, that withholding counts as an early distribution subject to a 10% penalty. It's a hidden cost that can devastate the conversion math. Most people don't know that this rule even exists and underscores the importance of having additional non-retirement funds available to pay the tax. Mistake number 5, poor post-conversion investment strategy. Converting funds, then investing them conservatively or using the same asset allocation across all different account types instead of optimizing for efficiency. If we have tax-efficient accounts, we'd love to make sure that those types of accounts are invested in a way that may grow more over time, which will shield more of the taxes from those accounts. Conversely, we might be thinking about traditional retirement accounts where we might have to pay taxes on those in the future and invest them more conservatively in more income-based instruments. This will reduce our future ordinary income taxes to be paid and required distributions. Mistake number 6, converting when inappropriate. This is the big one. People with smaller retirement balances converting due to general advice. If you have $100,000 in traditional retirement accounts. Your required distributions will only be about $4,000 annually in your mid-70s. Why pay 22% in taxes now to convert when all those future distributions might only be taxed at 10 to 12%? You're paying more to save less. And this is where it becomes that crucial for us to have a longer term plan to be considering where we might be in 5, 10, 15 years from now, not just today or next year. So when do conversions actually make sense? And the answer might surprise you. Despite the limitations, conversions can be powerful under specific conditions, but the conditions are very specific. The ideal candidates may look like someone who's in their 30s or 40s with decades of tax-free growth ahead, not someone in their 60s. May also look like somebody who's in a low tax bracket now, not someone who's in their peak earning years. May look like someone who has substantial cash reserves to pay taxes separately, not using IRA money, someone who expects significantly higher personal tax rate in their future, not just general fear about taxes. So some strategic opportunities here would be, number one, our income gap periods between retirement and Social Security. This is very specific timing to do this. Number two, systematically filling those lowest tax brackets, 10 to 12% over multiple years, not converting large amounts at high rates all at once. Another opportunity might be if we have large tax-deferred balances that will create genuinely burdensome required distributions. Remember, think about that 4% required distribution to begin. It's only going to go up over time per $100,000, $4,000. Notice how specific these conditions are. That's why so few people actually benefit during their lifetime. But here's what really concerns me. Let me show you who's actually benefiting from all of this conversion advice. The Roth conversion recommendation is an effective business tool for advisors. It addresses client fears, sounds sophisticated, and creates urgency. It checks every box for compelling financial advice. Advisors managing conversion strategies often charge fees on the assets being converted or the ongoing management of converted funds. So the warning signs to watch out for here. Number one, blanket convert now advice without personal analysis. One-size-fits-all solutions are rarely something that you should be applying to your situation. Next, we have fear-based urgency about tax rates. Act now or regret it forever. Next, we have recommendations that ignore your cash flow situation, assuming you can pay the taxes somehow. Next, advice that doesn't consider your specific wealth tier and treating everyone like they're the same. If you're hearing any of these approaches or even sniff at the sound of it, you're receiving sales advice, not financial planning. So how do you make the right decision for your situation? Here's a step-by-step guide that you can use to consider applying. Step number one, identify your wealth tier honestly. Under $500,000, $500,000 to $5 million, or over $5 million. Be honest where you actually are, not where you hope to be. Step number two, review the specific criteria for your tier that we discussed. Step number three, if you meet those criteria, model the conversion mathematics including all tax interactions. Don't skip the interactions, they're often deal breakers. Step number four, calculate your break-even point and determine if you'll have sufficient time to reach it. Step number five, confirm you have adequate cash outside of retirement accounts to pay conversion taxes. If the answer is no, we should be thinking thrice before cutting. Most people don't meet the criteria in steps 2 or 5, which indicates conversions aren't appropriate for many situations. Whether you are in the majority or should likely avoid Roth conversions or among the few for whom they may make sense, the key principle is this. Roth conversions are a strategic tool in the toolbox, not a default recommendation. Their value depends entirely on your specific financial circumstances. Instead of making decisions based on general market fears, your approach should be to systematically identify your wealth tier, evaluate the relevant criteria we explored, and review conversions thoughtfully only if the conditions align with your situation. Logic should drive your decisions rather than emotion. In retirement planning, there are no universal solutions. The loudest advice is often the worst advice. The most effective strategies are those built around your specific circumstances, timeline, and goals. If you want to explore further how this decision criteria may impact your situation and other areas of your financial plan that you might be missing, I'm leaving a few links in the description below where you can find some resources from me, as well as time to be scheduling a time to meet, to be reviewing your situation, to get some third-party objective opinion on some of the things that we might be missing. We'll explore some low-hanging fruit strategies that may work for your situation, things to consider, ways to minimize our lifetime tax bill, rather than fear-based advice. Just data-driven insights specific to you. And if this systematic approach helped you through the Roth conversion hype, share it with someone else who might be getting pressured into a conversion or not know how to approach it. Your share could save them from making a costly financial mistake. And with that being said, thanks for joining me, and I'll see you in the next video.